Since we got rained out, we're going to go over the Chapter 12 homework problems. Number 2. Colson Communications is trying to estimate the first-year cash flow at year 1 for a proposed project. The financial staff has collected the following information on the project. Sales revenues, $15 million. Operating cost, excluding depreciation, $10.5 million. Depreciation, $3 million. Interest expense, $3 million. The 40% tax rate, cost of capital is 11%. Question A. What's the project's cash flow for the first year, where T is equal to 1? Notice, sales minus operating costs minus depreciation, not interest. EBIT minus taxes. Add back depreciation, year 1 cash flow, $390. The point is that interest expense is not relevant. Looking at Part B, if this project would cannibalize other projects by $1.5 million of cash flow before taxes per year, how would this change your answer to Part A? Cannibalization is relevant. In Part C, ignore Part B. If the tax rate dropped to 30%, how would that change your answer to Part A? It would run the year 1 cash flow up from $390 to $405. Problem 3. Carstead Air Services is now in the final year of a project. The equipment originally cost $29 million, of which 75% has been depreciated. Carstead can sell the used equipment today for $8 million. Its tax rate is 35%. What's the after-tax salvage cash flow? There's our formula right there. Salvage value, that's what they're going to get in money, $8 million for it. Book value, $7.25 million. It was depreciated down 75%, so 25% of the value is book value. They're going to make $0.75 million on it. The taxes on that, 35 times the 0.75. The tax is taken off of the $8 million. So net salvage value, $7.7375. Question 5. Marble Construction estimates that its weighted average cost of capital is 10% if equity comes from retained earnings. However, if the company issues new stock to raise new equity, it estimates that its cost of capital will rise to 10.8. The company believes that it will exhaust its retained earnings at $2.5 million of capital due to the number of highly profitable projects available to the firm and its limited earnings. The company is considering the following 7 investment projects. Assume that each of these projects is independent and that each is just as risky as the firm's existing assets. Which set of projects should be accepted, and what's the firm's optimal capital budget? If they stick with the 10% and do not go outside for new equity, then they would only take those first 2 projects for $1.7 million. If they go for new equity at 10.8, then they would do the top 4 projects. Capital budget would be 3.9. 12.8. New project analysis. You must evaluate the purchase of a proposed spectrometer for the R&D department. Base price is $140,000, and it would cost another $30,000 to modify the equipment for special use by the firm. The equipment falls into the modified accelerated 3-year class and would be sold after 3 years for $60,000. The applicable depreciation rates are 33, 45, 15, 7. The equipment would require an $8,000 increase in net operating working capital, spare parts inventory. The project would have no effect on revenues, but it should save the firm $50,000 a year in before-tax labor cost. The firm's marginal federal plus state tax rate is 35%. Part A. What is the initial investment outlay for the spectrometer? The year 0 cash flow. The equipment at $140, the modifications at $30, net working capital at $8, so $178,000. Part B. What's the project's annual cash flows in year 1, 2, and 3? They've approached this in a little bit different way. Depreciation, this is the actual allowance each year, but this is the after-tax savings, which is the allowance times the tax rate. And we also arrive at book value, which, for Part C, gets us the tax on the gain. They're going to sell it for $60,000. The book value is $11,900, so they have a $48,100 capital gain, which they'll pay tax on. There's our year 0 expenses. This $32,500 is the $50,000 after tax, because the depreciation tax savings is after tax. Salvage value, tax, net working capital recovery, those are our cash flows. Net present value is a negative $8,783. Number 17. The Sorensen Supplies Company recently purchased a new delivery truck. The new truck cost $22,500, and it's expected to generate after-tax cash flows, including depreciation, of $58.75 a year. The truck has a 5-year expected life. The expected year-end abandonment values, salvage value after tax adjustments, for the truck are given here. Company's cost of money is 9%. Should the firm operate the truck until the end of its 5-year physical life? And if not, what is the firm's optimal economic life? Okay, here's how you approach this. There's the cash flows. There's the abandonment or the salvage value. If you operate it all 5 years, it costs you $22.5. You take in $58.75 each year for a positive NPV. If you only operated 4 years, in year 4, you take in $58.75 plus the abandonment value, a negative NPV. Repeating that, what we find is the optimal economic life is 2 years. Either run it 2 years or go all the way to 5. The point, just because something will run for 5 years doesn't mean that's the best choice. And number 18. Hampton Manufacturing estimates that its cost of capital is 12.5%. The company is considering the following 7 investment projects, shown right there. Assume that each of these projects is independent and that each is just as risky as the firm's existing assets. Which set of projects should be accepted, and what's the firm's optimal capital budget? Okay, to start with, you're going to take every one whose internal rate of return is greater than the cost of money. A, B, C, D, E, the budget would be $5,250,000. Now assume that projects C and D are mutually exclusive. Project D has an NPV of $400,000. Project C has an NPV of $350,000. Which set of projects should be accepted, and what's the firm's optimal capital budget? You accept the highest NPV, A, B, D, E, and the budget would be $4 million. And Part C says, assume that each of the projects is independent, but that if management decides to incorporate project risk differentials. Management judges projects B, C, D, and E to have average risk, A to have high risk, and F and G to have low risk. The company adds 2% to the cost of capital of those that are significantly more risky, subtracts 2 for those that are less risky. Which set of projects should be accepted, and what's the budget? It changes because now Project A with high risk is not accepted, but the low risk projects are accepted. The optimal budget, $6 million.